Okay, so this week, the economy basically sent three texts in a row: jobs weaker, gas pricier, inflation still weird. So, like the macro version of getting dumped, charged a fee, and put on hold.
And before we get into it, the economy is once again doing that thing where every headline sounds like it was written by someone who hates us personally.
Welcome, everybody. This is Weekly Market Breakdown. And today we're talking about the Fed getting stuck between a softer job market and inflation that still refuses to take the hint.
Yeah, inflation is that party guest who said they were leaving an hour ago, then sat back down, opened another sparkling water, and started talking about rent again.
So here's the big macro shift. The jobs report came in weaker than expected. Employers cut jobs in February. The unemployment rate moved up to 4.4%. And the overall picture looked softer because earlier data was not exactly screaming strong momentum.
Here's the unemployment rate, and you can see why markets are starting to pay closer attention to labor softness.
Right? The labor market did not collapse, but it definitely walked into the room looking like it had slept in its car.
And that matters because for months, the Fed's ideal scenario was basically this: inflation cools, the labor market slows a little, but does not break. And then maybe rates can come down gradually.
Instead, that whole script got rewritten by like a sleep deprived chaos intern with a Red Bull and access to the oil market.
On top of that, oil prices surged toward $90 a barrel after the Middle East conflict escalated, and U.S. gasoline prices jumped from around $3 a gallon to roughly $3.32 in about a week.
And this is where households really feel it fast. Gas prices, when this jumps, people notice immediately.
Which is such a rude move by the universe. Nothing says consumer confidence like watching the gas pump go up so fast you start rethinking every errand, every weekend plan, and whether fun is really necessary.
Then came more inflation anxiety. Wholesale inflation ran hotter than expected, and the Fed's preferred inflation measure had already been sitting above target. Markets are now worried higher energy costs could start feeding into expectations and consumer behavior.
This is core PCE, one of the Fed's key inflation gauges, and it helps show why inflation still has their attention.
Which is why economists get so intense about oil. It is not just the direct hit at the pump. It is that people start thinking, okay, if gas is up, what else is about to go up? And then everybody is like budgeting emotionally in real time.
Exactly. Even though policymakers pay a lot of attention to core inflation, which strips out food and energy, they still worry if an oil shock hangs around long enough to spill into wages, transportation costs, and broader inflation expectations.
Or in basic terms, one expensive thing turns into several expensive things because this economy does not know how to be dramatic in moderation.
So now the Fed has a classic dilemma. If it cuts rates too soon, it risks looking soft on inflation while energy prices are rising. If it keeps rates high for too long, it risks squeezing a labor market that already looks more fragile.
It is the policy version of trying to put out a kitchen fire while your sink is overflowing and your landlord is texting, just checking in.
Markets have mostly concluded rates will stay on hold at the March meeting, and now the big debate is whether cuts could start later this year if the labor market weakens more.
Traders went from rate cuts are coming to rate cuts are maybe coming if the data behaves, oil calms down, and the universe stops doing improv.
So why should regular people care? First, higher gas prices work like a tax on households. If more of your paycheck goes into the tank, less is available for restaurants, travel, clothes, or like replacing the appliance that has started making haunted noises.
Your budget turns into a hostage negotiation where gas wins, groceries refuse to cooperate, and fund money is no longer returning your calls.
Second, if the labor market softens, workers lose bargaining power. That can mean fewer raises, slower hiring, more cautious employers, and more pressure on people already dealing with high housing and debt costs.
Employers love saying we're being disciplined on hiring, which is corporate for we would still like all the work done, just ideally with less human.
Third, if rates stay higher for longer, expensive borrowing sticks around. Mortgages, auto loans, small business credit, credit cards. That affects not just major purchases, but the monthly math of everyday life.
At this point, every financial decision feels like a stress test. You are not just buying a car. You are proving character, resilience, and a willingness to pay 8.9% to finance a car.
There is also the uncertainty question. Some policymakers think this oil shock may be temporary and not something the Fed should overreact to. Others worry that if the conflict drags on, energy prices could stay high long enough to really complicate the inflation picture.
So one camp says, do not panic, this may fade. The other camp says, cool, but what if it does not? Which, to be fair, is also how I approach mystery leftovers.
And that uncertainty matters for markets, because markets are basically giant machines for overreacting to every fresh data point. One soft jobs report, and everybody reprices rate cuts. One hot inflation print, and everybody reprices again.
Financial markets are like that one friend who reads a text that just says K and goes, I have fully mapped the emotional collapse of this relationship.
If you are a household, what you feel is not the phrase policy dilemma. What you feel is gas costs more, debt is still expensive, and the job market does not feel as easy as it used to.
Exactly. Like policy dilemma sounds elegant and polished. My commute costs more and my company froze hiring sounds a lot more like real life.
The big question over the next few weeks is whether softer jobs turn into a real trend and whether higher oil starts feeding more clearly into broader prices and consumer behavior. If both happen at once, the Fed's job gets a lot harder.
Which is saying something because their life already looks like one long montage of charts, acronyms, and carefully managed panic.
We'll keep watching the jobs data, the inflation prints, and the energy shock so you do not have to panic refresh your bank app and your gas station loyalty points at 1:30 in the morning, wondering why your paycheck feels smaller without technically shrinking.
Remember to click that subscribe button, check out the other breakdowns, and we'll see you next time the economy rolls out another completely unnecessary plot twist.